Welcome to the channel. Today, you're about to enter a world that retail traders are never allowed to see. A world that quietly decides your fate the moment you click buy. This isn't about charts. This isn't about indicators. This is about the hidden machinery that calculates whether you survive or get wiped out. This is the story of the risk engine and how exchanges mathematically design your destruction. You think the market is chaotic, random, emotional, but the one entity that is always calm is the machine watching your every move. The risk engine doesn't blink. It doesn't panic. It doesn't celebrate your wins or mourn your losses. Its only job is simple: protect the exchange at all costs. And if that means sacrificing you, your hope, and your capital in a single instant, trust me, it will. Let's begin with the moment you place a leveraged position. You feel powerful. 10 times the buying power, 20, 50, maybe even 100. It feels like freedom. But what you're actually doing is stepping into a contract that says the exchange now owns the right to liquidate you whenever the math demands it. From that point on, your trade isn't evaluated by market potential. It's scanned by an algorithm that calculates the fastest possible route to zero. You think your biggest enemy is volatility. No, it's the silent math running underneath it. Let's strip the illusion. You deposit $1,000. You choose 20x leverage. That means you're controlling $20,000 worth of exposure. Powerful, right? But the risk engine isn't impressed. It sees only a fragile position. Why? Because that $1,000, your entire account, is now your initial margin. And the exchange needs to make sure that if the trade moves even slightly against you, it doesn't lose money. So it creates a boundary called the maintenance margin. This is the line between survival and liquidation. The moment your equity equals that maintenance requirement, you are no longer a trader. You're a liability, and liabilities get removed by force. Let's go deeper. Because here is the brutal formula that controls your fate. Liquidation price equals entry price, acts 1 minus initial margin position size. Where NIOS depends on whether you're long or short. Sounds harmless. But look again. That fraction, your tiny margin divided by huge exposure, means even a 4% move against you can vaporize everything. And that's exactly the point. The system is designed so that losses scale up, but margin never does. Now consider the real villain, risk weighting. Assets with more volatility are assigned higher risk, meaning the engine demands more collateral to keep you alive. So when you choose assets that move fast, you are actually stepping into a smaller and smaller breathable space until one bad tick suffocates you. Your P&L is being calculated every millisecond. Your equity is being compared to your maintenance requirement nonstop. And while you think, I still have room, the risk engine already knows that a 2-second liquidity sweep will finish you. Let's reveal the next hidden layer, the mark price. You believe the market price decides your liquidation. Wrong. Exchanges use a separate value called mark price, calculated using an index of external feeds, funding rates, and sometimes a weighted average of bid-ask depth. Why? To avoid manipulation, but also to liquidate you earlier. You might look at the chart and see price above safety, but according to mark price, you're drowning, and liquidation is triggered instantly. The engine does not wait for confirmation. There is no mercy candle. If mark price hits your threshold for even a fraction of a second, your account is seized. Now let's expose the real psychological trap, the illusion of control. You tell yourself you'll exit before liquidation. You'll manually stop out. You'll watch the chart. You'll react. But the system moves faster than your brain and faster than your broker UI can refresh. Because liquidation is automated, server-side. The moment math says you're done, you are done. You think you can handle risk. But the exchange calculates risk at light speed with every possible scenario simulated. Welcome to stress testing, the machine's ability to model your total collapse before it even happens. How do they do this? Through portfolio risk curves, convex models that show how loss accelerates exponentially as price moves. In other words, a tiny move doesn't hurt much until suddenly it hurts infinitely. And then they add volatility surface models, predicting how future price behavior could destroy you even faster than spot movement shows. So when volatility spikes, the engine increases margin requirements in real time. You might enter a trade safely, but the rules change mid-game. Maintenance margin jumps, your breathing room disappears, and liquidation price moves closer and closer, even when price hasn't moved at all. This is how a neutral position becomes a death sentence without warning. But wait, we're not done. There's a term few retail traders ever learn: auto-deleveraging, ADL. When too many traders are long and price dumps, when liquidation queues are full, when the insurance fund can't cover the chaos, the exchange doesn't care about fairness. It simply targets the most profitable traders holding the opposite side and forcefully reduces their position to save the exchange's balance sheet. You can be winning, you can be right, you can be positioned perfectly, and still, you can get cut down to protect someone else's failure. The house always wins, and ADL is the final proof. Now let's expose leverage caps, one of the biggest illusions in all of finance. Why do exchanges let you use 100x leverage on Bitcoin, but not on a tiny altcoin? Because they know exactly which assets can destroy them. High liquidity equals higher leverage allowed, because the engine can liquidate you easily. Low liquidity equals lower leverage, because liquidation might slip and cost the exchange money. Your leverage is not your power. Your leverage is the exchange's confidence that it can kill your trade instantly. Let's talk liquidation algorithms. Most retail traders think liquidation sells their position slowly. Wrong. Liquidation is often executed using incremental market sells at aggressive pricing, specifically tuned to cause liquidity cascades, wiping out multiple traders in a chain reaction. This gives us the phenomenon called a long squeeze or short squeeze, where liquidation events themselves become the fuel for amplified price movement. But here's the dark truth. Risk engines don't just react to squeezes. They calculate them. They know where the clusters of liquidation levels are, because every trader has already registered those levels in the system. The engine can predict exactly where panic will spread fastest. When you see a sudden wick, when price violently spikes up or down, you call it manipulation. But the risk engine calls it clearing the books. This isn't chaos. This is planned mathematics. Let's run one more scenario. You're long at $20,000 with 20x leverage. Your liquidation price is around $19,050. Price chops downward slowly, painfully. But you think, as long as I don't hit liquidation, I'm fine. What you don't see is the insurance fund's size, the funding rate imbalance, the skew of open interest. And when too many longs are underwater, the exchange has incentive to sweep the board. One violent wick to $19,049 for a millisecond, thousands get liquidated, and then price instantly returns. Retail screams manipulation. Exchanges quietly count their fees. You were never meant to win big. You were meant to trade often. The risk engine ensures that. Now here's the ultimate truth. You don't blow up because you are reckless. You blow up because the system is built to mathematically ensure you do. Your trades are fed into a model that continuously monitors your pain threshold. Your liquidation point isn't just a number. It's the most profitable distance to place your noose. Exchanges advertise high leverage equals high profit. But the real slogan should be high leverage equals high probability of liquidation before profit realizes. And while you're fighting for survival, the exchange earns on every step: funding payments, trading fees, liquidation penalties, spread slippage. You're losing, but your loss is their income stream. You're not a client, you're the revenue model. The risk engine has one life goal: never let the exchange lose a single cent because of you. And to achieve that, it doesn't evaluate your trade the way you do. You see candles, you see trends. The risk engine sees only equations and thresholds. Let's expose the deepest layer now, the risk waterfall. Step 1, your collateral absorbs losses. Step 2, your position equity absorbs losses. Step 3, the liquidation engine seizes your entire position. Step 4, insurance fund steps in only if absolutely necessary. Step 5, auto-deleveraging forces profitable traders to pay for your failure. Understand this clearly. You are not allowed to hurt the exchange. They have designed a system where everyone else can pay for your destruction, except them. Now let's dissect the most sinister part: mark-to-market risk models. Exchanges don't wait for price to hit your threshold based on your entry. They constantly recalculate your unrealized P&L using formulas like equities balance plus P&L, maintenance margin equals position size, maintenance margin rate. Liquidation trigger: if equity maintenance margin, forced close. This equation is the guillotine blade hovering above your trade. Every heartbeat of the market tightens the rope. Every tick down inches your account closer to death. Now watch how it gets darker. When volatility spikes, maintenance margin rate increases, meaning your liquidation price moves closer even though the market price didn't move. You can go to sleep safe and wake up destroyed, not because price changed, but because rules changed mid-game. The risk engine is not static. It adapts like a predator adjusting its jaws. Let's go deeper into volatility modeling. Exchanges use something called VR, value at risk, and expected shortfall. They simulate worst-case scenarios based on probability curves. If the curve projects rapid collapse potential, your survivability rating drops. When too many traders pile into the same direction, especially using high leverage, the risk engine raises margin across the board because crowded trades threaten the house. If everyone is long and price drops fast, insurance funds drain. So before that happens, the engine destroys the weakest traders early, artificially shrinking exposure. The blood of the weakest is used to protect the system. Still think this is just math? No. This is strategy. Let's talk liquidity haircuts. Exchanges score assets for liquidation risk. Deep liquidity means easy liquidation, small haircut. Thin liquidity means large haircut, making liquidation trigger sooner for safety. Illiquid assets get you liquidated faster. Liquid assets give the exchange more room to squeeze. Either way, they still win. Now, the most brutal element of liquidation, market impact algorithms. When your position is force closed, the engine doesn't care about the best price. It cares about speed. It sells aggressively into the order book, driving price even further against your direction. Your liquidation becomes a weapon, used to attack other traders' liquidation levels. One trader falls, their collapse pushes price, another liquidation triggers, and the cascade continues like a controlled demolition. They call this volatility. But the risk engine calls this harvesting. You want to know why wicks form? Not because whales want liquidity, because the engine knows exactly where thousands of stops and liquidation levels and a single sweep can clean them all at once. One candle, one moment, thousands lose everything. Let's expose cross-margining versus isolated margin. Retail loves isolated margin because it feels safe. Only this trade gets liquidated. But cross-margin? That's where disaster becomes systemic. One losing position bleeds your entire account, destroying multiple trades to save one doomed position a few ticks longer. The machine doesn't care which position is good or bad. It only cares which one dies slower. Ever wonder why your best trade gets closed while your worst one remains open? Cross-margining. Still think you're in control? Let's reveal the scariest component of all, liquidation buffer zones. Your liquidation price is not the actual trigger. Exchanges set a buffer above that level, liquidating early to guarantee the exchange profits from your destruction. They liquidate before you hit insolvency, so they can keep the leftovers. They don't wait until your account is zero. They liquidate while there is still something worth taking. This is why your so-called safety margin evaporates before danger arrives on the chart. Next, fees. Every liquidated does not just lose, they pay for losing. Liquidation penalty fees go straight to the insurance fund. So the insurance fund doesn't just exist because traders fail, it grows because exchanges profit when you fail. Liquidation equals income stream. Now, the final reveal. The engine doesn't only calculate liquidation, it calculates compliance. It monitors whether traders behave in a way that maximizes exchange revenue. If your strategy reduces fees, they restrict leverage. If your strategy exploits inefficiencies, they disable features. If you consistently win, you get flagged as toxic flow, and your order fills may deteriorate. The exchange is not your partner. The exchange is a competitive adversary with perfect information and absolute control. And here is the philosophical punchline. The risk engine doesn't punish stupidity. It punishes independence. The more you rely on leverage, the faster you die. The more you rely on precision stops, the faster they hunt you. The more you rely on conviction, the faster they break you. They want you trading frequently, emotionally, desperately, because the fee machine must keep running. If you stay disciplined and patient, the engine makes nothing. So it constantly creates urgency. Countdown timers, flashing liquidation levels. Add margin now, pop-ups as if they are helping you. They aren't helping you. They're convincing you to feed the monster with more capital before it eats you anyway. This is the truth retail traders never learn until it's too late. The risk engine was never designed to protect you. It was designed to protect the system from you. You are not supposed to win big. You are supposed to bleed slowly, paying small fees every step until the day you blow up in a blaze of liquidation that feeds the machine one final feast. And then they wait for the next deposit, the next hope, the next dream, the next victim. But now, you know how the system works. Knowledge doesn't guarantee victory, but ignorance guarantees defeat. And that is why this channel exists, to show you the hidden machinery behind the screen, so you stop being prey and start trading like someone who understands the game. The market isn't fair. The market isn't random. The market is engineered to take everything from the impatient and give it to the prepared. If you're ready to get smarter, if you're ready to fight back, if you're ready to stop playing the exchange's game and learn how to build strategies they can't exploit, then stay here. Because this is just the beginning. Thank you for watching. If you got value from this breakdown of risk engines, liquidation math, margin mechanics, and exchange psychology, smash that like button, drop a comment with your thoughts, and subscribe so you never miss the truth the market doesn't want you to hear. Keep learning, keep evolving, and keep surviving. Because now, you finally understand how the risk engine calculates your destruction.